Good morning, everybody, and welcome to today's morning market. So morning markets today is going to focus on the US economic data releases that came through yesterday afternoon. So there's really two that we're going to focus heavily on, and that is the producer price index, what we call PPI, and also the US retail sales data that came through. So first, what is PPI? So it shows the average change in prices received by domestic producers for their output. But what does that mean in layman's terms? So what that means is it measures price change from the perspective of the seller. So what did we see with the data? So the index declined by 0.5% in December compared to November. And that compares to analysts and economists' expectations that actually the index would increase by 0.1% overall. So you saw quite a big miss there. If you just dig into the numbers, so it was the largest monthly decline since April 2020. So it's adding to signs that inflationary pressure in the US is cooling. And we've seen that come through when we look at the inflation prints, when we saw the recent US CPI print coming in at 6.5%. If we dig into the numbers, goods prices were down 1.6%. led by a 7.9% fall in energy costs, and maybe to a lesser extent, a 1.2% fall in food prices. So again, those key components of what we've been seeing within the US headline inflation figure. So let's move on to US retail sales. So retail sales is a measure that shows the total receipts for retail stores and reflects the spending patterns of US consumers. So it's seen as a guide to the health of the US consumer through what they're spending. So what are the numbers? So retail sales in the US declined 1.1% month over month, and that was against forecasts of a 0.8% drop. So if we dig into those numbers, sales at petrol stations or gasoline stations, as they say in the US, recorded the biggest decrease, which was down around 5%, followed by furniture stores down around 3%, and motor vehicle dealers, which were down around 1.2%. So you've seen a little bit of weakness come through in US consumer spending. So what happens when we bring all of this information together? Well, when we bring all of this information together, you have to remember that the US Central Bank, the Federal Reserve, have been very aggressively raising interest rates. Why is that? The reason for it is because you have elevated inflation and they're trying to cool what is an overheated economy. Now, when interest rate rises come through, there's actually a lag before that actually affects the overall economy. And you're starting to see that come through now. So what does that mean? Well, what it means is that actually, even though these two data points won't stop the Fed from tightening monetary policy from here, it may mean that they tighten less aggressively than many people initially thought, and that's a positive. As always, True Potential Investments, our managers that we work with, will monitor key data points, key events, and we'll come back to you within morning markets. And just finally for me, it's going to be a bit of a shameless plug here. Please do watch our podcast. So it's a question and answer special. It stars myself, as well as starring 3 other people specializing in advice and different areas of the business. So please do subscribe to our YouTube channel. You can watch the podcast tomorrow, all of our other podcasts, morning markets, all of the information that we produce for you, so you can do more with your money. Thanks a lot. Bye.
If you're interested in taking your investing to the next level, or would like to know more about the options available to you when you retire, then download our free guides to ISAs and pensions. These are available in the video description below.